Going back to the 1950s, when the Federal Reserve began cutting interest rates, the stock market finished the next 12 months negative 5 times versus positive 16 times. Of the 16 times, 9 were accompanied by recession and the other 7 saw an expansion. On average, the market gains 11% following cuts with no recession, and gains 8% even if there is a recession. So what is the takeaway? The market is more likely to trend higher following a cutting cycle, whether there's a recession or not. It doesn't care unless there's a shock. 2001 and 2008 were deleveraging events. 2020 was a black swan. Today, the U.S. economy has entered a late cycle slowdown with rising unemployment, falling jobs growth, and sluggish economic activity. The world's second largest economy continues to suffer, which could have a nasty effect on the global economy. The oil market is also reflecting less global demand, signaling a possible global recession. Now, traditionally, GDP growth should be turning negative, but that's just not the case yet. Consumers may have given up on purchasing goods, but they haven't given up on experiences. Banks' willingness to extend credit is actually rising. Household wealth is at an all-time high, partly because homeowners saw the largest surge in home prices in a decade, increasing their equity values, and the equity stock market is also at all-time highs. The most recent economic data shows better than expected retail sales, industrial production, building permits, and housing starts. Naturally, lower rates should accelerate activity, and as long as inflation falls, the Fed and the Treasury can keep on pumping. Now shifting to markets. Following the Wednesday rate cut, utilities, technology, and Bitcoin have all outperformed the S&P 500. Utilities are the typical recession hedge, a stable industry with consistent earnings. Most people are going to pay their utility bill before they take a trip to the Bahamas. Well, hopefully. Utilities also have a mega growth driver behind them. With the rise of AI, data centers are popping up like mushrooms, and that means more electricity revenue. Constellation Energy just committed to restarting a nuclear plant to support energy demand for Microsoft's data center needs. That stock's up 20% on the day. The Nasdaq is breaking out of a technical pattern led by Meta making all-time highs. Tech is probably playing catch-up as it's underperformed the S&P since the yen carry trade crisis. And Bitcoin, representing crypto, is a pure play on liquidity. When global money supply growth accelerates, Bitcoin accelerates, and rate cuts effectively increase the demand for borrowing, which leads to more loans, more margin, and an overall increase in global liquidity. Bitcoin is a cyclical asset, which means it also loves tax cuts. In 2017, the Fed was raising interest rates, but the fiscal impulse from Trump tax cuts helped Bitcoin rip higher. So if you're betting on tax cuts, you're betting on Bitcoin and you're betting on crypto. But either way, the election cycle brings the biggest bundle of economic promises, which equates to more economic stimulus. And with both candidates being big spenders, cyclical assets are likely to boom. So now we know, historically, markets are more likely to perform when the Fed starts a cutting cycle. And in the 4 years of an election cycle, markets perform best during the pre-election year, the promises, and the post-election year, the delivery. Hold on tight. The promises are still building and the delivery is coming.